Should I buy individual shares or ETFs? That's a common question I've received in my 20 years of being a financial advisor. And in this video, I'm going to do a clean side-by-side comparison of the things that actually matter to Australian investors. Because the Australian economy is very different in the year 2025 than it was in the year 2000. And it's not just a matter of investing into BHP and watching your money grow. First, some quick definitions to keep us on the same page. When you buy individual shares, you're purchasing ownership in a single company, usually held under your chest with a broker. ETFs work a little differently. You're buying units in a fund that holds a basket of securities. You still trade them on the ASX, just like shares, but the fund itself follows an index or rules-based investment strategy, and you pay a small management fee for that structure and ongoing oversight. The big advantage? ETFs give you instant access to broader opportunities, whether that's overseas markets, Bitcoin, AI, or more. Keep this framework in mind as we go further. And today we're going to compare them on key dimensions such as fees and costs, access to international markets, ownership and control, diversification, liquidity, and of course, tax treatment. So you can decide what's best for you and your situation. Costs and fees. Let's start with what everyone wants to know. Fees. Let's look at individual shares. There's no ongoing management fee, only the brokerage costs, typically $10 to $20 per trade with most Australian brokers. So for a diversified portfolio of 20 to 30 stocks, you're looking at brokerage of around $200 to $600, plus additional costs every time you rebalance or make changes to your portfolio. Now, if you want to buy international shares, you're probably looking at 25 stocks. So that's like $500 up front. Then you have currency conversion fees, usually 0.5 to 1.5% each way, and foreign exchange spreads and international brokerage fees. So the total cost is getting up there, $1,000 to $2,000 or more. And this is in transactions before ongoing currency expenses. And every adjustment to your portfolio means more brokerage and currency costs. ETFs, on the other hand, have an annual management fee between 0.05% and 1.2%. And then you have the standard brokerage costs to buy and sell through your broker. So an example is VAS, which is a broad Australian market ETF. It has a 0.07% fee. So that means $70 on $100,000 invested. Then you have thematic ETFs, and they could range from 0.65 to 0.85%, such as cybersecurity ETF, HACK, that's 0.67%. Robotics ETF, 0.75%. Fees reflect professional management and sector expertise. So an ETF fee versus a DIY comparison. So once again, VAS, you're looking at $70 a year for $100,000 invested. Or a thematic ETF, could be $750 a year for $100,000 invested. When you factor in all costs, an ETF is still cheaper than building similar exposure yourself. ETFs include internal rebalancing, currency conversions, ongoing trading costs within the fund, and there are no extra costs when adjusting your asset allocation. This is done by the managers within the ETF structure. So if you're planning on having a diversified portfolio, it can be cheaper to go with ETFs. But if you're looking to have only a few stocks in your portfolio, which can be extremely risky, then individual stocks are the way to go. Access to international markets, individual shares. To invest internationally, you generally need an international brokerage account. So that involves currency conversion costs, foreign tax complexities, and higher brokerage fees on overseas trades. It is also worth noting that you cannot access some markets. India is a prime example. Or trading directly in other markets like China can be quite challenging. ETFs, on the other hand, a single ASX listed ETF can give you exposure to the US, Europe, China, India, Japan. Then you could get bonds or commodities or currencies and even factors like dividend stocks. And then they have hedged and unhedged options, which allow you to manage currency risk. ETFs also open up access to global themes and sectors with one trade. And this is an extremely important point. Australia makes up just 2% of the global market capitalization, compared with around 50% for the US and 12% for Europe. At the same time, the Aussie market is actually shrinking. The number of listed companies has fallen from more than 2,100 in 2017 to fewer than 1,900 today, as takeovers and delistings outpace new IPOs. And the performance numbers tell a similar story. Over the last decade, the Aussie market's done 9% per year, whereas the S&P 500 in the US has done 13% per year. Then there's the issue of concentration. Nearly half of the Aussie market is tied up in just two sectors, financials and materials. That's not diversification. That's sector risk. By contrast, the fastest growing areas of the global economy, think AI, cloud computing, electric vehicles, biotech, have only minimal representation on the ASX. And we cover these sectors and opportunities in our newsletter, such as QETH, Ethereum ETF, which is up almost 70% since we started talking about it in May. Click the link below to learn more. Ownership and control. This is where ETFs and individual stocks differ greatly. Individual shares offer direct ownership, so that means you own part of the company directly. That means you also get voting rights on things like takeovers and board decisions, and you receive full or partial, depending on the stock, franking credits with your dividends. And you can choose which shares to sell for better tax outcomes. You can also control what to hold or sell. So this can be quite useful during market corrections if you only want to sell some sectors, like banks, but not tech. ETFs, on the other hand, you own a bundle of shares through a fund structure. There are no voting rights and the fund manager handles it all for you. You can't pick or remove specific companies from your ETF, and all corporate actions like takeovers or spin-offs done for you. And then also when you sell a bit of everything in the fund, not just certain stocks. So individual shares are better for investors who want more control over their portfolio, and ETFs are better for those who want a more hands-off approach. Diversification. Famous investors like Warren Buffett always talk about the importance of diversification to avoid risk. This is yet another area where the costs can add up. So for individual shares, you typically need between 20 and 30 stocks to achieve diversification. In practice, if you're investing in Australia, you're still going to be concentrated in a few sectors. For example, financials make up 28% of the ASX 200. Materials make up 20%. The top 10 stocks, that's 45% of the whole index. So even with 30 stocks, most portfolios are overexposed to banks and miners. And growth sectors like tech, AI, and biotech are underrepresented or missing on the ASX. And the other issue is high volatility. Portfolios with under 15 stocks had 40% more volatility than broad market portfolios with no better returns. ETFs, on the other hand, are diversified by default. You hold between 20 to 2,000 stocks in a single fund. You can target broad markets, sectors, countries, or themes, and international ETFs, which are listed on the Aussie market, give you exposure to faster growing markets. Remembering the S&P 500 has averaged 13% over the past decade, whereas the Aussie market has done 9%, including dividends. ETFs also lower portfolio risk, giving you broader exposure, smooths out your performance over time, and it simplifies access to sectors and regions that are not well represented in the ASX. So if you're looking for increased diversification and potentially higher returns, ETFs, particularly ones focused on overseas markets, are looking better. Liquidity and trade execution. This is where the Australian market's limitations really show up. Individual shares on the ASX, you tend to have thinner volume and wider spreads outside the ASX 200. And below the top 100 stocks, liquidity becomes patchy and inconsistent. The top 20 stocks on the Aussie market make up 60% of total market turnover. So bid and ask spreads for major stocks might be tight, like 0.1% for CBA, but small cap stocks can widen to 2 to 3%. So this means when you're selling large amounts of stocks in small and mid cap stocks, can result in the price moving against you, or could take many days to complete your trade. And liquidity risk spikes during market stress. Spreads widen and trading may halt. ETFs, on the other hand, are supported by market makers and the creation and redemption mechanisms. Generally, ETFs enjoy better liquidity than small, mid cap, even large cap stocks on the Aussie market. And this includes niche funds. For example, Hack ETF often has tighter spreads than big cap stocks on the ASX because they have highly liquid US holdings. During crises like March 2020, many individual shares lacked any buyers and had wide spreads, while most major ETFs continued trading normally due to their liquidity structure. This information is especially relevant for investors who have larger portfolios, as liquidity can be a real problem with individual stocks compared to ETFs. And finally, tax treatment in Australia. For individual shares, you're eligible for the 50% capital gains discount if you hold this share for over 12 months, and you also receive franking credits from Australian companies. This means you can target high franking stocks directly. For example, the big four banks often frank dividends at 100%. Tax reporting is manual, which means you need to track dividends, franking credits, and CGT events for each holding. This makes it more complex as your portfolio grows. ETFs, on the other hand, are also eligible for the 50% capital gains discount after 12 months. And Australian equity ETFs can pass through their franking credits to investors. International ETFs are subject to foreign withholding tax, though most investors can claim a foreign income tax offset. to reduce double taxation. Tax is reported via AMIT statements, and this includes cost-based adjustments, and that's typically issued to investors between July and September, which may delay your tax lodgement. The tax reports do offer detailed consolidated reporting that can simplify your tax filing. So in conclusion, here's where individual shares make sense. If you want concentrated bets and prepared to do deep research, if you're building a franked income portfolio from Australian names, and you value direct control, and you have significant time for research and monitoring. And here's where ETFs make more sense. You want instant diversification and simple offshore access. You prefer lower admin and cleaner tax reporting, and you want access to higher performing markets such as the NASDAQ, Bitcoin, emerging Asia, and so on. And it's important to look at performance too. Over the past 10 years, the Aussie market has returned approximately 9% annually. This compares to the S&P 500, which has returned approximately 13% annually. This means $100,000 invested in the Aussie market 10 years ago will be worth around $237,000 today. The same amount in the S&P 500 will be worth roughly $338,000. That's over $100,000 difference. And the easiest way to invest in overseas markets as an Aussie is through ETFs on the ASX. So if you're interested in learning about the hottest AI, crypto, energy transition, and other key sector and thematic ETFs in our newsletter, such as CNU, which has grown over 16% since we started covering it just a month or so ago, there's a 28-day free trial available now. Click the link below, and I'll see you in the next installment.